This is the Business Breakfast on Dubai Eye on One, on the UAE's #1 talk radio station.
All right, the latest report from the guys at Property Monitor show that real estate sales continue to power on. Year-to-date sales for the first 9 months of this year have eclipsed 2021 as a whole. We're very pleased to be joined in the studio by the Property Monitor COO, Jan Jahinki. Jan, good morning. Thanks for joining us.
Morning. Thanks for having me.
Let's talk volumes first. We've already surpassed 2021, and that was not a slow year.
No, I mean, 2021 was a great year, and this year's just been even better. So 3 quarters in, and we've just surpassed what was done last year, about 68,000 transactions for the year, and on pace to probably do about 90,000 this year. That's huge numbers.
Why so many more?
So what drove the original market recovery was villa and townhouses, right? We bounced back from that saw transaction volumes go up. And now what we've seen is the off-plan market really start to surge, and seeing it surge not just on launches, but sales and also the handovers coming up of new properties.
Why is off-plan growing so fast? Is it just because it's there?
In a way, I mean, developers have confidence. If we look at the market cycle, you see the more confident, the bigger developers typically get in first after recovery. And as the market's proven itself, you see your smaller and secondary developers coming in. That's what we're seeing now. So it's not just your big quasi-government developers and the big boys playing, but now it's the smaller ones coming in. Of the 33,000 or so new units launched this year, it's across from about 35, 40 developers bringing those. So it's not just your big 4 or 5.
And what has all that meant for prices?
Well, on the off-plan market, there's a lot of competition, right? But what they're launching is at a myriad of price points. There's so much coming on at that ultra high end, right? The stuff that's 3,000 dirhams and up per square foot for apartments, and a little bit lower than that for the villas and townhouses. And there's a lot in sort of the lower and the mid-market, but where there's kind of a gap is that main mid-market, upper mid-market. They're not building as much towards there, which for me is a little bit off.
When you say it's a little bit off, what do you mean?
So I get the ultra market, that ultra luxury market is surging ahead, but the amount of units coming on in that space, the amount of people that can actually afford them, and then when those units, even if you can afford to buy it now, when they hand over what the rents will be, I think that might be a bit of a market disconnect. You tend to see things gravitate towards the median, to that middle price point. And we're not seeing that. We're seeing it at the both ends of the spectrum, so that lower end and the higher end. So it's just typical market sense is that the majority of people are going to be in that median range, and that's not where they're building the main things now.
Okay, so what does that mean then for future supply and the ability to find somewhere to live?
So look, there's a lot of supply coming on. This year, we're going to see about 35,000 units handed over. We've already seen that same amount of launches almost this year. By the end of the year, expect to be 45,000. There's going to be inventory coming on. What type of property types are coming on? It's mainly apartments, right? It's probably going to be 85, 90% apartments, and the new construction trends are still towards that. So if you're looking for an apartment, there's going to be more inventory and options, but there's still going to be a shortfall in villa and townhouses, and there's really missed opportunity right there now for more of those projects to come on and fill that supply void.
One of the things that I like about this report is that it recognises that not everybody is buying property. You also look as rents as well. You've got yields up at about, I think it is a 3-year high. Put that in context for me.
Yeah, so just over 6.5% now. We haven't seen that number in almost 3 years.
That's the rise?
That's the rise. So sorry, the yield, the gross yield, 6.5%. Highest we've seen back up to that point in 3 years. Why? The market is incredibly tight. There's low supply, low vacancy rates in rental properties, right? Prices for villa and townhouses have plateaued, so you haven't got that price going up where the rent has to match it, and now you've just got basic supply and demand. Not enough supply, a lot of demand in the space. You've got would-be home buyers that haven't been able to purchase, or they have purchased off-plan, but now they've got to rent. So much demand there, and now it just keeps pushing those rents up, and as prices in some areas plateau, the yields are going to increase. But this is the first month we've also seen it across apartments, villas, townhouses. All 3 property types, yields have increased.
So what does that mean going forward? Richard was very keen for you to start giving us some predictions as well. Where are rents going?
Right, we'll get the Zahn crystal ball out. Up. In short, and unfortunately for most of us, up. In the apartment market, they will probably go up the least. In the villa and townhouse market, because there's significant lack of supply, they'll go up more. But again, it comes down to new and renewal. If you're renewing, you've got some protections in place. If you're taking a new lease, you're going to be paying market rate, right? And those market rates will be significantly higher than they were 12 months ago, and in 6 months, they'll be higher than they are today.
And yet, if I look at what's happened to price appreciation of sales here, 2% in September, fine, highest since last year in June, but you've used the words plateau. Are we starting to see anything cool?
So if we look over the last 6 months, price appreciation slowed down. If we look further back, about a year and a half ago, price appreciation was over 2% a month. This is the first time we've been over 2% a month. And what I've been talking about previously is we want to see it around 1%, sub 1%. We don't want to see growth rates that are crazy, because the quicker it goes up, the quicker we get to that point where it's going to start to go down.
Well, Zan, on that point, we've had a message in from one of our listeners, no name on this, saying, can someone explain what's the difference between now and 2007? And just in case you weren't here in 2007, the real estate market was absolutely booming and then had a mega crash during the financial crisis.
One, it was a financial crisis, right? So everyone in experience. Are we heading towards another one, to a recession? Yes, but as far as we hear from most, it's probably going to be mild, right? Dubai was also in its infancy then. It was an emerging market. It was one of those posts you come to as a hardship, so there were more things there. The fabric of society here has changed. People are here long term, right? In 2007, you talk to someone, they'd only been here a year, 18 months or so, and the longevity was 3-4 years. Now you've got people that are routinely here 7, 8, 9 years. So you've got people that have planted roots, which means they're not exiting most of the time and running. If there is a huge event where job losses and things are there, that's going to add incredible pressure to the market, and we could see something more severe.
Jan Jahenki, COO of Property Monitor, thank you for joining us this morning. 20 seconds, what's the last quarter going to look like?
Strong overall. Expect prices to tick up mainly in the apartment segment. That's what drove this 2% recovery, not in the villa and townhouses. They're plateauing. Expect rents to keep going up and mortgage rates to be one of the main concerns for end users.
Well, thanks very much for joining us this morning. We appreciate your time.